Hey everyone, I hope you and yours had a fantastic Thanksgiving holiday with family and friends and that the turkey leftovers are taking up less fridge space now. Mortgage rates are feeling less bloated going into the new week. Let's see where we're weighing in at in this week's Mortgage Market Update. So where are rates headed? In the near term, it's lower. The holiday season is off to an early start as home loan rates have declined to the lowest level in over 2 months. The decline in interest rates is not limited to long-term interest rates like mortgages. Short-term interest rates have also declined, and the financial markets are pricing in no more rate hikes by the Fed. It's sometimes head-spinning how fast sentiment can change. The market is currently pricing in just a 23% chance now that the Fed will cut rates as soon as March 2024. Why? The economic news of late has been bond-friendly. Inflation has started to ease. Unemployment is ticking higher, and reports on the economy show continued softening in addition to weaker economic news. The geopolitical landscape carries a lot of risk with fears of tensions in the Middle East escalating. We are also seeing recession fears escalate around the globe. Add it all together, and it likely means the Fed has indeed finished hiking rates, with the peak or terminal rate achieved this last July. Here's what's on tap in the days to come. Later this week, we will get the Fed's favorite gauge of inflation, the Core Personal Consumption Expenditure Index, or PCE. Expectations are for the annualized rate to come in at 3.7%. When the Fed says they are holding rates higher for longer until inflation hits 2%, the core PCE is what they're talking about. If the reading comes in cooler than expected, rates could take another leg lower. We also have some treasury auctions where the U.S. sells debt to fund our government. After the recent decline in rates, the 10-year note has moved from 5% to 4.4%. The markets will be looking at the buying appetite after the recent decline in rates. If investor demand is firm, that will be supportive to the lower levels we have been seeing. Now let's take a peek at the charts. You can see how bonds have broken off the down escalator with rates moving higher over time. It now appears as though rates are at the beginning stages of creating an up escalator where rates move sideways to lower over time. Forthcoming news and confirmation that inflation is moving lower will decide whether a new trend of lower rates emerges. Thanks for spending a few minutes with me today as we continue to work through this crazy market. Be sure to smash that like button, comment, share with others. I look forward to helping you bring loans to life. Have yourself a great week.